In this video, I'm going to demonstrate a very powerful daily bar pattern called the smash day pattern, originally documented by Larry Williams. I'm going to demonstrate it working on euro-dollar forex pair, and then I'm going to test out some modifications. One of you guys, Sardine, he actually emailed me and asked me, he said, how do you think an ATR-based stop loss and profit target would work on the smash day pattern? So that's exactly what we're going to look at. I've done a few studies showing the effects of different ATR-based stop losses and profit targets. Sardine actually suggested a level of 1 times the ATR, that's a 14-period standard ATR, so 1 times the ATR for a profit target, and 1.5 times the ATR for a stop loss. Logical values, but we'll see whether that works or not. Then, at the end of the video, I'm going to show you my preferred stop loss, trade exit, and trade filter. For those of you who haven't heard of ATR, it stands for average true range, and it's a way of measuring the volatility of a market. It's an indicator that pretty much every charting package has, and I mentioned that we're going to be using the length or the average over the last 14 bars or 14 days in the case of this strategy. Firstly then, let's have a look at what a smash day setup looks like on the screen. So what you can see, this third bar here, this is actually the smash day, and the smash day consists of the close of the bar being less than the low of the previous day bar. The minute we see the smash day, that's our setup to place orders for the next day. So this is a long smash day setup. So the minute we see that, we then place an order the next day on this bar here. It's a stop order to buy at the high of the smash day bar. So at this level here, the next day, we would have entered the market. And of course, the opposite is exactly true for short trades. We would have seen a smash day which would have had a close higher than the previous day's high, and then we would have set a sell short order at the smash day low for the next day. Okay, so smash day long setup, look for a close here less than yesterday's low here, then set a buy at the high of the smash day. The results that I'm going to show you are testing euro dollar, and I'm going to be using data from Oanda from January 2010 through to May 2022. And we're going to be testing using one full lot, and I've included a round trip of 6 pips or $60 worth of commissions. The comparisons which I'm going to do, for the sake of the length of the video, are pretty much only looking at net profit. So we want to know what's making the best or the most net profit. Of course, there's lots of other different metrics we should be looking at when evaluating a trading strategy, like the accuracy or win rate, the stability, the equity curve, drawdown, etc. But just for now, we're looking at pure net profit. The first test is going to be comparing the strategy using 2 different stop losses. The first stop loss is going to be an ATR-based stop loss, and I'm going to go from using 0 through to 5 times the ATR in steps of 0.5. So we go 0.5 times ATR, 1, 1.5, etc. When you see the level of 0, that's going to be equivalent of using no stop loss whatsoever. And then we're going to use a fixed pip stop loss, and I'm going to go from 0 through to 500 pips in steps of 50 pips. The exit for this baseline strategy is going to be sort of no exit at all. It's going to be a stop and reverse exit. So if we get long, then we're only going to exit if we hit the stop loss, or we get an entry signal to go short or go to the opposite direction. So let's have a look at the results comparing both the fixed pip and the ATR stop loss. So I've created a bar chart for you, and you can see that the lighter colour blue bars are using the fixed pip stop loss, and the darker one using the ATR. And along the bottom, 0 is using no stop loss at all. 50 is equivalent to 50 pips, but it's also equivalent to 0.5 ATR. 100 pips or 1 ATR, all the way through to 500 or 5 ATR. And what's apparent is they're all pretty stable, which is good. There's a bit of a bad period in the middle there, 2.5 times ATR. Prior to that, the fixed pip looks like it's working ever so slightly better. After that, the ATR looks like it's working slightly better, but there really doesn't seem much difference between using a fixed pip or an ATR stop loss. Previously, when I've looked at this strategy, I've liked using the 250 pip stop loss, although 250 pip is probably the highest, but it is probably an outlier, so probably average that out. But it certainly is nice to see that stability across all of the different inputs. So next, I'm going to show you a test using an ATR-based profit target. Now, seeing as all the stop loss values were quite even, and Sardine originally suggested a 1.5 times ATR stop loss, that's what I'm going to use for this next study. So we're going to set the 1.5 times ATR stop loss, and then for profit target, I'm going to go from 0 through to 5 times the ATR, again in steps of half an ATR. So if I went to 3 ATR profit target, in this case with a 1.5 times ATR stop loss, we're going to be looking at a reward to risk ratio of 2 to 1. So let's see those results. And as in the same case as using the stop loss, the value of 0 is using no profit target whatsoever. It's not using 0 pips as a profit, it's just switching off the profit target. And we can see that using no profit target at all does produce the most net profit. And then we've got the ATR values, and we can see that right up to starting at 2.5 is quite a good value, or a mid value. Then they drop off slightly, 5 coming up again. But it looks like anything from 2.5 through to 5 times ATR is a stable area for the profit target. But this kind of confirms what I often see with these rule-based or algorithmic trading strategies, and that is typically the most net profit uses no target at all. I rarely use profit targets in my own personal trading strategies too. Lastly, let's look at the performance report. We go over to MultiCharts and I'll compare 2 different strategies. The first one will be using the 1.5 times ATR stop loss with no profit target, and we've just seen the results there. And then I'm going to show you the results using my preferred exit, stop loss and trade filter. First, let's look at the performance report of the smash day using the 1.5 times ATR for the stop loss and no profit target. That's what the equity curve looks like. Making 58,000 net profit with a max strategy drawdown of 28,000. So let's compare that to my preferred version, which is this top chart here. We're making more money, 63,000 net. The max strategy drawdown is far less, and the equity curve, I think you'll agree, is much nicer. If you'd like to know exactly how I like to trade the smash day pattern, including the trade filter, the exit that I like to use and the stop loss, then I've included them along with the MultiCharts code. I've included them all in my trading course. So not only do you get the rules, but you get the MultiCharts code. If you're a MultiCharts user, then you can take that code and then you can test it out, modify it even more, or even trade it. And in the course there's also a bunch more strategies. There's 6 in total. If you're interested in that, take a look. I'll leave the link for that down below. But for those of you who aren't ready to invest, I'll also leave a link to my free 22-page Beat the Market Strategy Guidebook, where I outline in a PDF 3 more strategies, all for free, a little bit like this one. Obviously, they're not quite as good and not as comprehensive as the ones in the paid course, but they are really good. I know a load of you have got some really good use out of that, so link for that down below too. To conclude the results of this test today using the ATR stop loss and the profit target on the smash day pattern, it pretty much confirms what I've been finding out for the past 6-7 years, which I've been developing algorithmic trading strategies. And that is, it's really hard to beat a fixed pip or a fixed dollar stop loss. And also, profit targets generally tend to reduce the overall net profit of a strategy. It's funny how simple often works the best. ATR, or average true range, changes as the volatility of the market changes. So you'd think it would be a little bit more in tune and you'd think it would be more accurate. But as we've seen, a fixed pip often works best. And Larry Williams, who's done decades of research, also suggests that fixed dollar stops do work best. Well, thanks for watching all the way through. I hope that's been helpful, and I hope some of you may have even enjoyed the video. Next time, we're going to be looking at a triple moving average strategy. It's meant for euro dollar, but I'm going to be testing it across multiple Forex pairs. So if that kind of strategy interests you, then make sure to look out for next week's video. And please do me a quick favour, if you have liked this video, please give it a thumbs up and maybe subscribe to the channel. Until next time, this is Jared Goodwin, and thank you.